Good evening. This is Mark Mendonça from MCA-EC. Welcome to the Empower Me series on international tax for Indian Americans by Cecil Nazareth, who is a global accountant working from Connecticut. Mr. Cecil Nazareth is a partner with Nazareth CPA. It's a CPA firm with offices in New York City and across tri-state area. He has an MBA in finance as well as MBA in information technology from Columbia University. He's also a professor of global accounting at Fordham University in New York City. Mr. Nazareth is a chartered accountant and a CPA. He's an eloquent speaker and has conducted several sessions on international tax for the ICAI, the Bombay Stock Exchange, CFO magazine, and several CPA firms and companies around the world. Most recently, he has published a book on international tax and compliance handbook with a special emphasis on India-US tax. Mr. Cecil, welcome to you.
Thank you very much, Mark, and appreciate and thank you for giving me the opportunity. I'm competing with the Grammys, so I don't think I can do a better job than the Grammys. So if they get bored, anyone in their right mind listening to taxes on a Sunday night as opposed to the Grammys got to get their head examined. But I will do my best to give you a few nuggets. At the end of the day, it's about saving money. This is the book. I delayed the book another couple of weeks. It was almost final on December 13th. It was my dad's birthday, and he died 1 month before that, but way back in 1984. So I dedicated the book to my parents, but I thought this session is very important, and I do sessions all over the world. I did the new tax law to three of the largest firms in America outside the Big Four. And I did this recently as 10 days ago, and I got my schedule and lined up pretty well. But I think it'll benefit everyone. There will be an ebook published in the next 2 weeks, and you can go to my website, nazarethcpas.com, so you'll find it there. And you can purchase the e-version, and then the physical hard copy will be in the mail in about 2 weeks' time. That should be all final. So we are still going through dotting the I's, crossing the T's, because the new tax law is significant. So I hope everyone can benefit from this session. So next one, in the interest of this is, always consult. This is only an educational presentation. You cannot construe this as legal or compliance advice, and I cannot get sued for this presentation. So consult your attorney, CPA, or tax professionals when you deal with compliance issues, because the facts and circumstances vary in each particular situation. So we're going to talk about U.S. tax law, individuals, then we talk about corporate, individual, we'll talk about international, FBAR, estates, gifts, and then tax organization structures, etc. So very quickly, winners and losers with the new tax law. If you haven't heard the tax changes that have taken place in the last 2 months, then you're living under a rock. The real estate is going to benefit from 39%, which is the highest rate, is down to 29.6. Real estate and architects, etc. We'll talk about that later. Individuals, 39.6 down to 37, so a point and a half. Corporations, these are big corporations, Apple, Google, etc., 35% to 21. Estate exemption doubled. First it was 5.6 million, now it's 11 million. 529 plans now applies for school and college tuition. Now they've brought it down to elementary and school level, so that's even better. Architects, engineers is a fast-through benefit we'll talk about later. And private equity, if you are in private equity, you have to hold interest. Before, the rule was 1 year, you treat as carried interest, so your rate of taxation is only 23.8 as opposed to your individual rate, and they want you to hold this interest for more than 3 years to qualify. Low income people, I don't know, most Indians are in the high income, so we won't go there. Tax cuts expire in 2025, illegal. There's no earned income credit today. If you have less than a certain amount, the government gives you some money back. The biggest thing that will affect us all on the phone, and I assume most of the people are in the tri-state area or high property tax state. So now the cap is going to be $10,000 on state, local taxes, and property taxes. So that's going to be a big hit to everyone, especially New Jersey. Okay, another one to bear in mind, and people don't know this, but if you owe the IRS more than $50,000, they can revoke your passport. So you go to the airport and you realize your passport is revoked, and they'll send you a few notices, and you don't pay up, then you're in trouble. So 30% for a whistleblower also. The people don't know that your neighbor complains about you thinking you're making a lot of money and they're not. And if you do get caught and the IRS does collect an amount of 100,000 because you're delinquent for whatever reason, they get 30% of that reward. Payroll taxes, I'll just script that. Immigration is tightened, everyone knows that. And ICE visits now, immigration, they're really getting strict with HB1 visas, L1 visas. So I suggest improve your documentation if you've not already done so. Okay, we're on slide 9. Corporate taxes, biggest change here. Now, I'm talking big corporation, we call it C Corps. So the corporate tax is one of the highest in the world, 35. They've dropped it to 21%, which is very significant. Individuals from 39.6 to 37. Capital gains rate still the same, 23.8. Standard deduction is bumped up from 13,000 previously, now it's 24,000, and no SALT deduction, so you're capped at 10,000, and then personal exemptions are repealed. So there's no longer, if you're a family of 4, you got 2,000 each, it was $10,000, or $8,000 rather, no more. It's all gone. They pumped up this major, 24,000 is a big one. Slide 10, we talk about child care credits. If you have any kids, it's from 1,000, it moved up to 2,000. 529 plans I mentioned already. Medical expenses, they've reduced the limit from 10 to 7.5. So you might be able to be eligible, but it's a very, very high threshold. Individual healthcare mandate this year, in 18, the tax is still applicable, so $630 if you don't have health insurance. But starting in 19, there's no more that penalty. C Corps, I mentioned, slide 11, 35 to 21. Now, there are two types of pass-through entities. What we consider pass-through entities, S Corps, LLCs, partnerships. Okay, they're currently taxed at an individual rate, but what the new law provides is a 20% deduction of qualified business income for some PTs. Now they exclude some others like attorneys, CPAs, doctors, etc. excluded. Reason being, they didn't want all these self-employed professionals to create a S corp and get this benefit of this 20% deduction, lowering their tax bracket. So if they were 37% and they just incorporated, then they would have got this benefit. So they excluded most personal service companies, and so you don't get that deduction. But all others, if you're manufacturing and a small business S corp, then definitely you'll get that deduction. Now, no AMT for corporations, but for individuals, AMT, alternative minimum tax, still applies. It's a higher exemption rate. Now, additional Medicare tax, this still applies. It's not gone away. It used to be called Obamacare tax. This still applies. Okay, here's some few things. Slide 13, SALT, which I mentioned, state and local income taxes and real estate taxes. Limit is 10,000 before it was fully deductible. So everything is gone other than charitable contributions, interest, and state taxes. So you have to have a threshold higher than 24,000 to claim that Schedule A. So it's going to be very difficult. Now, for the Northeast and California, it's really going to hit hard. For the Midwest, 24,000 is a lot of money, and that's why they get a bit of, the East and West Coast are sacrificed, but the middle states will benefit from 24,000 deduction. New going forward, only $750,000 equity limit, so you cannot get a mortgage. First it was 100,000 now currently, and it's going to be capped at 750 for new debt. But if you have existing debt, this 1 million still applies. Okay, mortgage interest, like I mentioned, 750, no home equity deduction. Today you can deduct up to $100,000. Going forward, you can't. Charitable contributions still allowed. Standard deduction raised to 24. SALT tax I mentioned again, and no personal exemption. So there goes all your deductions and exemptions. Here's a good one, capital X. So section 179 is called, you can buy equipment. So if you buy computers for your business, say you buy 5 computers and it costs $2,000 each, $10,000, you can write off that equipment in the first year itself. Okay, then investment tax, I already mentioned 3.8 still exists. But here's some tax planning suggestions. Now it's too late, but in December I do these sessions. I tell them 2 extra payments, you'll increase your deduction. A charitable contribution, you have to give it to issue is to approve charities. And then finally, good documentation. The biggest problem I find is we don't keep good documentation, and that's the reason why we get into trouble. So you need to have your tax returns organized and all documents that support your tax return. Now, SEP plans are still allowed. So you can, if you have a self-employed business with no employees, you can still open a plan before September 15th and still benefit from that. If you have an IRA, then it's April 15th. And DBP is a defined benefit plan. If you're older, 50 or older, and you want to set up a plan, you have a lot of income coming to you, then defined benefit plan is a good one. And education credit still 2,500, lifetime learning $1,000. And now kids and grandkids, I always think that grandparents can also contribute to some 529 plans. It was always there, but people don't use it. Foreign tax credit, we'll talk about that, and childcare credits we already mentioned. Okay, so here's your brackets, number 18. So I'll just leave this slide open for 1 minute. So you can very well pick your bracket, which is your married filing joint in the left column. And then they call it a marriage penalty act. Marriage is a penalty. I don't know why they call it marriage penalty, because when two incomes get added on, your slab jumps up. So there'll be 4 or 5 rates. The Senate passed a little more rates: 10, 12, 22, 24, 32, 35, and 37. So that's where we are. Okay, this is an important slide, sourcing rules. I get some of these questions, and I do a lot of international work. So if you have interest income, so you have income in India, then it depends on the bank that pays you the income. So if a US bank pays you, it's US sourced income. If an Indian bank pays you, it's Indian income. A dividend income, same thing. A US corporation pays you, then it's US income. If an Indian corporation, Tata, pays you, or Birla or whatever, then it's Indian income. Personal services depend where the services are rendered. If you render in the US, it's US income. You render the service in India, it's Indian income. Rents, royalties, great example. So you have a house in US and you rent it out, so it's US income. You have a house in India and you rent it out, then it becomes Indian income. And gain or sale of real estate, where is the property located? And last, on personal property. So if you have a piece of art, it depends on the seller's residence. So if you are a US citizen and you sell a piece of art worth $10 million, then it's US income. If you're an Indian citizen and sell a piece of art worth $10 million, then it's Indian income. So this is an important slide, slide 19. I do a lot of international work, so people ask me these questions. And by the way, you're not taxed twice. If India, let me go back here. If you're taxed in India, then you get credit for what you paid in India. So there's no double taxation, it's just one. Okay, corporate. I'm going to switch a little to corporate. I know many of you are not in the corporate area, but it's good to understand because you might get this question directly or indirectly. So I put corporate tax rates for the rest of the world. France and Germany, 30%, Japan, India's 30%. So now US comes into 21. And then the next column, I put risk and transparency. Why that is important is because you can have great tax rates, but if no one is paying tax or you have constraints of moving money in and out, then you have a problem. So, for example, on the risk return model, I put it China less. It's more risky, so less reliance. France is okay. Germany okay. Japan. India also corruption, foreign exchange outflow ban, so you cannot bring out more than $1 million. Brexit, that's another problem for UK, and then US, we have federal and state and political issues. But overall, I think US will be a place to do business going forward in the next 5 years. Okay, this is a territorial system versus credit system. What it means is credit system is you get taxed on worldwide income, but you get credit for what is paid in the foreign country. So this is more for corporations. 35% drop to 21. Now only C corporations can avail of this benefit. Okay, FDII, you don't need to know this. This is more for corporations. I do corporate tax. It's federal, it's foreign derived intangible income. That is maybe Apple, Google, etc. Guilty income is not GUILTY. It's a guilty. It's global intangible low tax income. So Apple moves their IP to Ireland and then sells it from there. So they get royalty, at a lower rate as opposed to paying US taxes. Next one, very important, one-time tax. You must have heard on the news all along that Apple is going to pay so many billions of dollars in tax. So all money sitting outside the United States was untaxed until they repatriated the money back to the United States. So that was a major loophole, and the amount has been sitting there from 1961. That was the rule. And companies that have post 1986, all retained earnings, they could bring it back to the US, one-time deal at a 15.5% if it is cash, and if it is non-cash, it's 8%. So it's really, really, all these companies, multinationals, have billions of dollars, 2.3 trillion sitting outside the United States. In fact, if there's one thing in this slide, this is where the corporations are going to pay this tax, and the government is going to get a lot of money, and corporations are going to be flush with cash, and that's where they'll be producing, and that's how they are subsidizing these taxes for everyone else. Inventory, we'll skip that because I think it deals more with if you produce inventory in the U.S., it's U.S. income. Produce inventory abroad, it's foreign income. Subchapter S. Now this is important. If you as a U.S. citizen hold 10% or more of the shareholder of a foreign corporation, and you're a director, then you have to file a form called 5471. Many people will not tell you that, but it is very important, because if you don't, that's the new F bar, I call it. Okay, interest limitation and BEAT tax, that is more for corporations, not for us individuals. So, okay, get one, two more on corporations, and then we'll go back to individual. Earnings and profits. So all the Apple, Google, and all these companies have been keeping billions of dollars abroad. So you want to make sure they can bring it back. But it includes a specified foreign corporation. So now going forward, all these corporations will not pay tax on their foreign income. That's what this whole slide is talking about. So I won't get there. Oh, for you to remember is 15.5 cash and cash equivalents, 8% on non-cash. Okay, then FTC carried forward. If you don't use it, you can still allow it. So that's just another good slide is for US versus foreign. Question is, I get asked this question by a lot of business owners. Okay, I have $100,000. Where should I invest? Okay, now the whole world is an open place. Some places are more, but the transparency is an important factor. If you cannot verify, like the Middle East is a little harder, South America harder, China, forget it, so Hong Kong a little better. Then you talk about bribery, corruption. I don't have to go there. Everyone on the call knows about it. Paradise Papers and Panama Papers, you have heard about tax evasion shelters. DTA and DTL, the deferred tax asset, we are going to skip that. But here's a good one, optimum tax structure. Very important. I get a lot of calls on business saying, hey, what is the best structure should I form, either the US or India? And I think sometimes they could talk to their cousin, their relative, and more often than not, they get the wrong answer. So you really want to study this. What is your best structure? Because once you form a structure, taxation follows that structure. So you might want to really consider, what is your structure? How do I form a company? So you can have a US company buy an Indian company buy a US company, but you got to understand the economics and what are you trying to achieve and how can you optimize your tax. I don't say minimize, I say optimize your tax position worldwide. It all depends on facts and circumstances, very important. So don't, 7 largest economies I just mentioned there. I'll skip this because this deals more with corporations. I mentioned this one. Personal taxes, pass-through entities. This is a good one. This might apply to a lot of people on the call. So S corporations, you will get a 20% deduction of taxable income, okay, but not at the individual level. So a corporation will receive on qualified business income. So let's say you as an S corp, you're manufacturing a product, and you have net income of $100,000, you'll get a 20% deduction. So no tax on that 20%, but you'll pay tax only on the $80,000 at your individual level. Deduction phases out at 315,000. If your income is, all of the income is high above that, then you're out. Doctors, accountants, consultants, finance professionals, all personal services are excluded from taking this deduction. So you're specifically out. Okay. This is more with C corporations. I said 30% for interest, and rules for guilty income is more intangible income. Section 179, I said allowed, and then foreign profits I already mentioned. Okay, business taxes, we mentioned that. Corporate loopholes, they are trying to plug that from a wealthy person setting up an S corp just to benefit from that rate reduction. Corporate AMT is eliminated. Research and development still applicable. We might still want to consider that. Quickly, we'll go through F bar and then we get some more changes. So U.S. citizen residents, physical presence test, worldwide income. For the individuals, it's not a territorial system. Still, we have to follow the old system. And so you'll still be taxed in India, but you will get credit for what tax you paid in the U.S. In the U.S. for tax you paid in India. This one we mentioned, no one has heard of this concepts, but I practice in international tax law. So talking about BEPS is base erosion profit shifting. So Apple and Google would move their IP to Ireland at 13% tax and therefore move all their profits overseas. PFIC, now you might be affected by this if you invest in mutual funds, etc., in a foreign country like Birla Fund, then it is a PFIC and you pay the highest rate of tax on that number. So be careful with that. I mean, IRS hasn't enforced it, but technically it could be reinforced. Okay, sourcing rules we mentioned here. I think I'll skip this slide. Okay, good slide on slide 36. Approximately 20 million individual families paid income tax. Only 1.6% of the population pay. Government revenue from corporation personal tax is only 6% of GDP, and all other countries is 12% of GDP. So this was where I got this information from. It was in Time magazine also. Okay, FBAR, foreign bank account reporting for people who still haven't complied. There's a way out. You can pay 5% penalty and file 3 years amended returns, and provided it's not willful and you have sufficient reasons to document, then you should be in good shape. But folks, try to comply with the law on both sides. I think I often get questions and the people tell me that, oh, they won't find me, I don't care. Now the banks have become very strict. Even India, they are asking you for a social security number because they have a similar compliance. It's called FATCA, Foreign Account Tax Compliance Act. Actually, they borrowed the US system. So the Indian government can share information with the US government and US government can share information with the Indian. So the US Treasury is going to ask the Indian government, tell me all your Indian citizens who are hiding money in the US, and US can ask the Indian government, show me all the US citizens hiding money in India. So it can be an exchange of information. Banks will start reporting this information. And if you go to the CBDT, that is Central Board of Direct Taxes, India, there's a special section on foreign tax, FATCA, which is Foreign Account Tax Compliance Act. And you can see it right there on their website. Mutual fund companies, I've mentioned this, some have even stopped accepting US investors for compliance requirements. KFC, know your customer, that's what it's not KFC, you become a Kentucky Fried Chicken instead of know your customer. So as soon as they get all the information, I think you become a KFC. ID in your home country, I think social security number, EIN number, so they are trying to copy US's FBAR to see who's hiding assets and income from the US Indian taxing authorities. NRO accounts, TDS is 30.9 or 30% highest rate, and PFIX, you would have to pay your highest US tax. Okay, here's a great example. So slide 39. I'll give you a minute to look at it while I get a water break. Okay, so let's say you're a US citizen and your global income interest from FDs, you have fixed deposits in India, and here it's called CDs, and your dividend of 10,000. So your Indian income is $40,000. Your tax deducted at source in India is 30% of 9,000, which is $9,000 on the $30,000. By the way, dividends not taxed in India because a corporation picks up that tax. Dividends are not taxable, I mentioned. Now, U.S. returns, say you have a salary of $200,000, you add your Indian income of 40, your total global income is 240. So you calculate the U.S. tax on that, which is 84, and you get credit for Indian taxes, which is 1116. So your net payable to the U.S. government is $75,000. I mentioned government IGAs, FATCA, FBAR, the dates moved up. It's April 15th, but you get an automatic extension till October 15th. And I mentioned this should be, in April 15th of 17, it changed. So in 18 also it'll be the same. Now in India, banks ask you to fill the FATCA form, so you have to be careful. Now, Section 4 is pretty good. I left JFK's, a lot more is expected from those who have been given a lot, and everyone on this call, I assume. A majority of folks who have come from India, we are very grateful. I came here in the early 80s, and I was the first Indian at Ernst & Young, so I remember, and I'm very grateful for everything I've got. So I never forget that. And I do a lot of seminars for our own community. I do ITV for free. I do a lot of stuff like that, but I teach on the international circuit, so I get a lot of comments and I learn a lot. Okay, gifts. So now you can give a gift of 14,000 to a child or a grandchild. two of you, so two parents can literally give $28,000. So husband can give 14, wife can give 14 to one kid, so 28,000 is exempt. So you don't have any gift tax. Estate tax, $5.3 million is an exemption. They doubled it now, so now it's 11.2, if I remember correctly. And then portability means if the husband dies or wife dies, then they can transfer their unused exemption to the other person. But just check the state. The state levels are much lower, New York, Connecticut, and New Jersey. But New Jersey is phasing this out. I think the state's also phasing out estate tax. Oh, I mentioned here on slide 44. So I think the gift tax is going to go up to 15,000 exclusion. And the double exemption for estate tax is 11.2 million going forward, and they're going to eliminate the tax by 2024. Okay, here's some good planning for kids and grandkids for anyone on the call who is interested. Consider family office. Our organization, our CPA firm, Nazareth CPAs, we are three brothers. We're all three CPAs and CAs, and we can do family office, which implies that you can, we can take care of all your assets, including trust, estates. No one can do this in a smaller environment. So, but our firm can handle all sides. That is, gifts, estates, trusts, and income tax also, both on the U.S. and in the Indian side. Teach them financial skills. Let them earn money. Don't leave them money. Always an important characteristic. A crummy trust, very good that the income in the trust is trapped there for the kids. No one else has access, so it's excluded from creditors, etc. Important thing, you should talk to an attorney if you want to set that up. Gift of stock, I always recommend stock as opposed to cash. Buy a stock on the kid's first birthday, so when they become 50, they'll thank you and they might pray for you, if at all. So that worth, the Coke stock, which may be $100 today, could be 50,000 50 years from now. Parents matching charitable contributions. I always recommend that the kids make the contribution, parents match it up, so it gives the kid a sense of giving. Fine 29 plans, I mentioned that. Now it can go down. By the way, grandparents can also give 529 plans, and then it's even lowered to the level of secondary and elementary school. In fact, our practice now, we have come across a lot of Indians or wealthy Indians who are now in 60 and above. And what happens is now it's a question of wealth transfer. How do you transfer money to the next generation without having a major tax impact or tax burden? Moving along, we'll have the last few slides and I'll have a few questions, and I can get you back to the Grammys as soon as possible. So optimum entity, I really think I get a lot of questions, and I'd help companies start up. Today, is at a C corporation at 21% makes the US a very competitive place in the world. And like I showed you, the other countries are far ahead, far higher than the US. But we forget there's state taxation also. S Corp taxed only once at an individual rate, that still applies. Partnership still a flow through. Most business people look at ROIs after tax. So US is a very stable place to invest money. So, business people who go all over the world, they always think that, okay, US, their money's safe. The rupee will not devalue against the dollar, right? The dollar is pretty strong. It will have some minor currency adjustments, but I don't think it will depreciate that much. And after all, it's a global currency. US state tax, in addition to federal tax, just don't forget that. Sometimes you get trapped in this 21%, but you can pick a state like Texas. There's no state taxes. Florida, Texas, Washington, three states that come to mind. Okay, what's an appropriate structure? I think this is, like I mentioned, I started this session by saying, always focus on structure, because you cannot change the structure as you go along, and consulting your family and friends is even worse. So take a good professional who knows what they're doing. I get the question, they come to me and say, I want to start an LLC. I ask them why. They say, oh, my brother started one and I started one and I want an LLC. But they don't understand you could be taxed as a Schedule C or a partnership or an S Corp. So there are three options. So you look at pass-through entities is important as long as you get taxed once. Sometimes non-taxable benefits to employees, you should consider if you have staff, then, might as well give your staff a bonus instead of paying the government. A better thing is give a Christmas bonus, etc. Pay estimated taxes and adjust withholdings. If you owe too much money to the government, is a penalty. If you owe too little, or if you get a major refund, then you actually have the money sitting with the government and it's doing nothing. So I often tell you adjust your portfolio depending on your tax structure. Small business expensing, 1 million, I mentioned that. Small healthcare premium, sometimes I've spoken to doctors and they say, hey, they don't mind covering some few employees, and sometimes now it's very prohibitive, but it was a healthcare mandate. But they get a deduction, so the company gets a deduction, but employees don't pick it up as taxable income. So that's a great benefit for paying healthcare for employees. And some companies do it, some don't. Most pick up 80% of the cost. 401k plans also very good for employee retention, year-end bonuses I mentioned. So be generous to your staff. They are the most valuable commodity. Then dividend versus salary. You want to focus on how much can you take out as dividends, because there's no social security taxes on dividends, but there is social security on salary. So a doctor earns $100,000. You may choose to take 70 as salary, 30 as dividend, and that way they can save some taxes on by distributing as dividend. I see major changes in the global front because I see Indian companies wanting to do business in the US. You cannot be called a global company without a US footprint. US companies wanting to do business in India, same vice versa. Tax structure is very important, and I'll mention I have several cases where we come across situations where a taxpayer, they are 10% shareholder or director of an Indian and a director of an Indian company, and they forgot to file Form 5471. The penalty for that is close to $10,000 a year. So you really want to get serious on this and make sure you're complying. And finally, here's our contact information. Like I said, our book will be out. My book will be out within the next 10 days. I was planning Jan 31st, so I'm positive we should get there. And I have 3 offices. We are 3 brothers, so I handle the Connecticut office, and I come to New Jersey maybe once a month, if at all. But my brother Chris handles that, and then Clem is in the New Jersey office. So we talk about any tax questions. But the book will be available nazarethcpas.com. So while I go back, Lancy, I'll open it up for questions. I take a few, and then this is the book that will be out in the next couple of weeks.
Thank you, Cecil. This is Mark Nancy Mendonça. So I have a few questions in the chat room.
Good.
If you have more questions, you can always put those in the chat room, and I'll take one at a time. So with that, let me take the first question. The question says, would the QBI, which means Qualified Business Income, apply to a partnership architectural firm?
No, architects are getting a special break. The maximum tax on architects is 29.6. So yes, they will be entitled to the 20% deduction indirectly.
Okay. The next question is, any idea with the India budget, would long-term gain on listed securities on the exchange become taxable?
Don't think so. At least I don't know. I'm not aware of that. So I'd have to defer to my Indian CA on that. But right now, it's not taxable.
Okay. So next question, any tip for a single parent family or for those filing under head of household status? I think the question refers to the tax reforms and anything that has been done for the single parent family.
No, nothing. The rates will just be adjusted accordingly. So, but there's no specific guidance on single family person versus anyone else.
Okay. There's a next question. When is the due date for Form 5471?
Oh, that's with the tax return.
Which
So
means
if you file on April 15th or extended dates October 15th. Okay, it goes with your individual tax return. But folks, it is real serious. I had a client. I'm going to give you an example. I hope you don't mind, Lance. It'll be 1 minute. Person was building a major place in real estate building in India. Major, I'm talking with 20 investors. And so 5 years ago, he got a notice saying you didn't file the 5471. It was so serious. At 10 years default, it was $100,000 penalty. It was serious, and I jumped in there, and the accountant didn't know, the client didn't know, and I got in there and I wrote a letter to the IRS. I filed all 10 years. Luckily, the building was still under construction; it wasn't complete, but they were taking him to the cleaners. because that is a serious violation. But then finally, this was 2012, so the IRS was pretty liberal at that time, so they waived the whole 100,000 penalty, didn't charge him a dime, and the client was really happy. But now going forward, they will not waive the penalty. They are going to charge you the $10,000 penalty. So they don't have jurisdiction to waive it anymore. So if you've been delinquent, you better speak to someone and get that straightened out, because that is the new F bar, because you're hiding assets and companies outside the US jurisdiction. Serious penalty, $10,000 a year not filed. No, the chances are very rare with whatever excuse that you can get away with it.
Thank you. The next question is F bar due date same as 1040 due date,
Yes.
or is it June 30th?
No, June is gone. No longer June. It is April 15th and extended up to the due date of the return, automatic extension till October 15th.
Okay. Well, what do you mean by automatic extension?
You don't have to file any form. If it is, they just keep October as the last date. October is if you are an individual, you have April 15th, correct? You all people file, but you do get an extension to file till October 15th. So most people and high net worth individuals never file on April 15th. They all usually file by October 15th. For corporations, it's September 15th, and individuals, it's October 15th.
Okay.
Last date to file the return.
So maybe the high net worth people take a lot of time to count money. That's why.
Absolutely.
Anyway, I have a next question, which comes
Yes.
as what is the implication of inheriting real estate in India? I think it's from a tax perspective.
There's a good example in the book. In a nutshell, no issue. But when you inherit, you should take the cost of valuation on that day. If not, you'll get into trouble down the road. And later on, when you sell that property, it'll become a problem. So I'll give you one quick example. Your father bought the property in India for $100,000, and now on his date of death, he died in 2016 or 17, whatever. And then the value of that property was 1 million, right? And now you turn around and sell it for 1.2. So your gain is only $200,000 technically. But if you didn't file a form called 3520, these are special forms which implies inheritance to the IRS. Now they will not know that property was 1 million sold for 1.2. They'll think it's 100,000 because they have no information on the basis of that property. So gifts, inheritance, the form number is 3520. You have to file that form, and then you're compliant. So when you actually sell that property, the gain is only 200. There's no tax on inheritance. Okay, it's zero, because it's what you have to figure out. Step up in basis, what we call as accountants. Otherwise, your liability will be pretty high.
So the inheritance date is the date of the death, is it?
Yes,
Okay.
but the basis should be valued at that date. So I urge you to get a valuation around the date. Within 3 months of the date of death, you want to figure out what was the value.
Okay. The next question is, the Indian tax year is April to March, and US is January to December, right?
Correct.
So the question is, how do you calculate taxes paid in India since the Indian tax assessment year does not match with the US
No,
tax
you
year?
have to prorate. You have to take 3 months of one year and 9 months of another year, and then bring it into US, into calendar year. So you'll drop 3 months in one year, add nine that accordingly, and you have to get back to the US side. So you have to go by calendar year. Otherwise, your foreign tax credits will all get messed up. So, we do this for hundreds of clients. I mean, I was the first guy in international tax way back. So you have to go back to the US return and go to the calendar year basis. So adjust the Indian return to the calendar year return.
Okay, the next question is, let's say you have the dividend and capital gain. I think you gave an example in one of your slides.
Yes.
You have dividend and capital gain in India, and according to Indian taxes, they are not taxed there, right? So if you file taxes there, do you still have to pay for those income in US?
Yes. Dividend in Indian tax law. See what's happening. You're going to two tax laws. Indian tax law is one, and then you're going to US tax law. First is source of income, second is residency. For taxation, there's only two things. One is source of income. So dividends is income. For India, they don't tax it because the corporation pays for it, but it's still income all the same, right? But in the US, dividends is regular income, so you have to include it in your return, and you will get credit for what you paid in India. But in India, the corporation is paying, not you, so you don't get a credit. But you need to include in the US return because that is income.
Yeah, but if corporation is paying tax on your behalf, so don't you get the credit for those
No,
taxes?
you don't. You don't. The Indian tax law is very different. They have a 42% tax technically. It's 30% corporation tax and 12% dividend tax. Okay. In the US also, AT&T pays tax, right? The whole purpose of C corporation is double taxation. So AT&T pays tax, but then when they distribute dividend, you pay tax again, right? So there's no difference.
Hmm. The next question about selling a property in India and bringing the cash into US. So the question is, what is the tax implication, best practices on bringing cash into US upon property sale in India?
Yeah, you have to go to the CPA, and this is also covered in the book. I don't remember what chapter exactly, but we covered this topic. What you have to do is first is file the Indian return, so everything is done. Then the CA in India will issue a form called 15A or 15B, and then you have to file that with the Reserve Bank of India, and then the Reserve Bank will give you permission to repatriate up to $1 million in any given year.
Is there tax here for that income?
No, it's only repatriating, right? You already that gain will be shown in your tax return. Same gain. India charges 21% capital gain, so 20 plus 1% educational surcharge, right? US is the same, 23.8%. So you'll pay a difference of 1% in the US on that capital gains.
I see. Okay. And then again, the date of capital gains, then is same thing. You have to see when the
That won't
property.
change. Yeah, which year did it fall into, right? There's a date is when you sold, is a date when you sold. Nothing to do with Indian return versus US return. So if you sold in April, right? In Indian return, it'll be different year, but US, it'll be calendar year. It's simple.
Right.
You have to go
So
by
if
the
you can go,
exact date of the sale.
yeah. Okay. If you can go to slide number 37, there's a question on that.
Yeah. This is F
So
bar.
yes, F bar.
Okay.
So 5% penalty is on what?
On the bank balance, highest bank balance. So let's say you had 100, 200, and 300,000, right? So 5% of 300,000 is $15,000 penalty, and that's it. And they'll close it up. And 3 years
Okay.
amended return, 6 years F bar, because this is the statute of limitation. But you got to write a good comment saying that you are amending the returns because you forgot to include this income, whatever. And it should be non-willful. Okay, I repeat this. I've handled some of the most complicated F bar cases here, so you cannot walk in there. We have a current case which is involves $20 million, and the penalties are pretty steep. And 10 million was F bar, so the government is looking for $5 million. Highest penalty on F bar is 50% of bank balance.
Right.
It was really rough. So, but in these cases, smaller cases, if the amounts are insignificant, then they are pretty generous. They want you to come into compliance more than anything else. They are not interested in pursuing cases because the cases are too small. And if you have less than like $300,000-400,000, they're not going to waste their time. But if you have 2 million, 5 million, and you are aware of it and you don't file, then the penalties are pretty tough and pretty serious.
So what is that bullet on 6 years F bar? What does it mean?
You need to file the F bar forms for 6 years. You got to file 3 years amended return, but 6 years F bar foreign the mentioned 6 years. So let's say we are in 18 now, right? So you'd go back all the way to 12, right? So file the F bar forms. That's it. But tax returns only 3 years allowed required.
Right. And then for the documentation purpose, is it 7 years that you're supposed to keep, or is more than that?
Usually 7 years. You're talking about retention, record retention, right? For
Right.
tax returns, yes, 7 years. But unlimited if there's fraud, okay? So suppose they catch fraud that you have not done something 5, 10 years ago and you hid money or whatever, or you have Bitcoin, I don't know. So they might, okay, fraud is unlimited statute of limitation. But everything else, 5 years, and the IRS can only audit you for 3 years. they will not go back beyond 3 years. So that's another. So even if the return is wrong, you can fight it in court and say, suppose 2010 return comes up, you're like, oh, I'm not taking this liability. I'm not paying for it.
So they can go only up to 7 years, you're saying?
Three.
Oh, three.
They can audit only three. But if there's fraud or substantial underpayment, they can go back any amount,
I see.
any number of years.
Okay. The next question you mentioned about some companies do not want a business or investment for U.S. residents, for example, the mutual funds and things like that,
Yeah.
because of KYC.
Yes.
I'm tied to your KFC anyway.
You like
So
that, right?
right, yeah, right. So what you're saying is it good to and at the same time you made a comment about you know U.S. doesn't matter where you invest your money, right? So is it good to invest in mutual funds and things like that in India because the market is probably going much higher? What's your advice or recommendation?
This is a tough one. We as CPAs are not allowed to give financial advice, but I think you have to look at three dimensions. And in my book, I comment on this. It's called accounting, finance, tax, and law. Right? So it's ATF. You know, it's accounting. What is the implications? Finance. What is the rate of return on investment? Right? You look at that after tax. Right? So you don't want before tax, you want after tax. So if you put 100,000 in India, what's the implication? You put 100,000 in the US stock market, what's the implication, right? But when you put in India, you got foreign F bar. I had a client who actually did that, right? So 10 years ago, they are telling me CDs give you 10% interest. So Cecil, why we put the money here for 1%? Let's move 100,000 to India. They did. But the rupee devaluated from 45 to 70 or 65, right? So you lost your shirt. People don't know that loss is deductible. That loss is called an ordinary loss under Section 988. That foreign exchange loss is deductible, and 99% of the people don't know that. So if you invest 100,000 and you got back 68,000, right, because of the currency devaluation, then 30,000 is a loss, which can be claimed on your tax return. In fact, we have a couple of cases right now going on. So you can claim these losses, but so it depends on, it's all a prediction anyway as to where you invest your money, but we are not the right people to ask where is your money best optimized or used. Or I have a feeling the US will be the best place to invest. This is just my personal advice, nothing to do with, because at that 21% corporate tax rate, the companies have so much money on their balance sheet that they can do whatever they want. I mean, just think about the money built up from 1986 till today. There's 30 years of retained earnings. They are bringing it back at 15%. You just go and open up Apple's balance sheet. They were rich before this bonus, right? So now every company is going to get so rich in the US that they can acquire, I would say, a lot of companies worldwide. And that's what's going to happen. That's what's going to propel the stock market more than anything else.
Yeah, and then we are seeing it, right? We're seeing this in the last year or so
Absolutely.
because
And in
of
the
this
last two
new.
months, you saw that because people don't understand that dividend repatriation. They have not paid tax. I call it breaking the pinata, right? There was a big pinata, untaxed money. They just broke it. Now, there's so much money has come out of it that they don't even have investment opportunities for that money. So I am strong believer in the next 3 4 years it will be significant. But I think in the long run it'll increase the deficits. That's my personal take. But that'll take more than 5 7 years or 10 years. But for the next 5 years they're cash flush. They got so much they can do five things: stock buybacks, capital X, capex. They can give bonus to stockholders. They can get dividends, and I'll give you 20 reasons they can do this. But I will definitely believe the U.S. companies will outshine all the counterparts because if you go to this slide, let me go back one, and you can see the rates, corporate rates in other countries, right? Look at these corporate rates: 33 France, 30 Germany, Japan, 31, 30 India, right? When you go to 21, lowest in all the top seven economies in the world. I pulled this from the top seven economies. Now, China, why would you want to invest in China? You cannot bring out more than 50,000. Then there's corruption. Same thing with India. You can't bring out money. So those two are gone. Now, Europe is also struggling, but their rates, you take 21%. I mean, that is just gold. So I see the US companies really ramping it up like there's no tomorrow.
Mhm. The next question I have is if you have to invest in child education in mind, is it Roth IRA better or 529 plans? Because both of them grow tax free, right?
Yes. So Roth IRA, or what was the other one? Or
529 plans.
yeah, both are good. But I my advice to our clients is if you're less than 30 or below 30, then you should do Roth IRAs because your appreciation will be far greater than you pull out. The appreciation is not taxed. The 529 plan is always good, but it's plus and minus. College will cost you an arm and a leg. You know, I think both are good alternatives. I couldn't tell you which one would be better.
Hmm. Okay, so the next question is, what is the meaning of signature authority for bank accounts for FBAR purposes?
Nancy, these are more questions than in my book, man.
See,
I
she
could have
will
written a
always
book out of these questions.
come up with the next version of the book, right?
I'm telling you, these are more questions than I can handle in one session. In all the sessions, I handle two or three, but it's no problem. People don't like the Grammys; they like my tax stuff. There's something wrong. Anyway, what was the question again? Let's go back. Oh, FBAR, signatory authority. If you are a joint signatory authority, you have a ability to write a check. The bank has your signature, then you are a signatory authority. Simple, plain and simple. Are you there?
Yeah, yeah. I'm reading through if there are any questions. So uh, I think I've covered all the questions that are there. Maybe people got scared that you. So we have about 5 to 6 minutes left on this session. If any of you have any questions, please shoot those questions on the chat window, and I will pick up. I think I picked up all the questions that were there as of now. So we can give probably a minute or so.
Yeah.
Any other? Uh, so until people pick up, so maybe I can
Yeah,
ask.
let me tell you a few things. I think that'll be helpful. Listen, folks, everyone on the call. I've been in the U.S. from early '80s. My brothers, three of us from '72. I strongly recommend get a good CPA, get a good tax attorney, go for good advice. One of the issues I face in corporate, and I teach a lot of CPA firms. In fact, I've done 5 sessions to major CPA firms in the top 20 in this country. And the golden advice is try to get the best advice, try to get the good attorneys, don't try to guess stuff on your own. I know we are cheap. We come from India, so we think. I changed my attitude when I first came to America. I often believe I don't mind paying the right amount. Even till today, I don't know stuff. And I'm happy to go to a bigger firm and ask them, what, I have this situation. What would be your advice? And I get consultation. I know what I don't know, even at this stage of the game. Even I wrote this book and I still have some questions and comments that I don't know 100% when I'm advising corporations. But you want to be on the right side because you cannot get into trouble by not knowing. By the way, ignorance of law is no excuse. Like FBAR, I was telling people, but no one listened to me, right? Now I'm telling you 5471. I'm telling you because you will get caught. There's stuff that they are really cramping down on. FBAR, they collected $5 billion. So what I have learned in my years of practice is try to do the best thing, try to do the right thing, try to improve your portfolio. It's now we try to say, oh, I can get this done for $200. I can buy TurboTax and put it in. Yes, you can. No one is saying no. It's like, fast food. You go to McDonald's when you want a little better meal, you go to a diner, and you want really ambiance, then you go to a really nice five-star restaurant. So the professional services are the same way. So go to a good attorney, good CPA, and that will help you in the international arena. It's not that easy. We spent years trying to understand complicated tax law. And we make those mistakes over and over again. And I often, oh, Cecil is the best you can do on your fees. I'm being honest. We are one of the best in the world, and we really charge high fees. But we have no time if someone wants to mess around. I've done 3 of the most complicated F bars. But we were there with the client, and we resolved the issues. They still got jail time of a couple of years, but that was reduced from 20 to 2. But I tell you, do the right thing, do the best job you can, get an CA in India, let them file a return no matter if you have income or no income. And that way you show compliance with both sides, and that's very important in all the cases we handle. We try to make sure that you're whole, you can stand behind what you've done. Don't cut corners, it only comes back to haunt you. Any more questions, Nancy?
Yeah, we have a question or two.
Okay.
What I think maybe this is a simple question. What is the minimum amount that requires to declare FBAR?
$10,000. It should be more than $10,000.
So the 10,000 is not per account, right? It's a total outside the
Yes.
country.
Yes.
It doesn't matter whether it's in China or India. It
Anywhere in
has
the world.
$10,000 US
Yeah,
dollar.
even Canada is required.
Okay. And then, so the question is, does that amount include the real estate?
No, it does not. It's pure bank balance.
So what are called the liquid assets, right?
Correct.
Including stocks and everything.
Yes. Stocks, because if you had sent money, you convert it into stock. So indirectly is yes. But people don't use if you read FBAR specifically, it's bank account only. Okay, so be very careful. I don't know what's the nature of the stocks. Some people include their mutual funds in that category. Stocks is not basically a bank account. It's not, even though it's liquid asset, is not a bank account technically.
Yeah, but the FBAR asks you to put stocks and mutual funds
Yes,
and then
yes,
life insurance,
yes.
everything, right?
Correct. That's correct. That's correct.
Right.
There's another form, 8938. People might want, there are different thresholds for both. Okay, F bar is 10,000, 8938, the thresholds are much higher, 100,000 or 150,000 for people filing joint. There's a form, look it up, 8938.
Mm. So there's a question about any authority has gone back this FBAR and come back to the people and penalized or something based
No,
on the filing itself.
99%, if it is below certain thresholds, like I said, below $400,000, they're just going to, you got to get a good reason why you didn't file or you didn't know or what's going on. And then they are ready to move it along. I mean,
No,
they
no.
usually.
What the question is, I think you filed. Let's say you have 500,000, you filed. But then have they gone back to the taxes and see whether you have seen cross-verified and things like that?
No, I didn't understand the question. See, if you file, then they're not going to come back to you. They'll send you a letter saying they approved and acknowledged and you're done. Right. So they don't. But there are cases. There's another program called OVDI, Offshore Voluntary Disclosure Initiative, OVDI. Now, say you have $500,000 or $1 million and you're fully aware, you can go into that program also. Then they're going to check you out in full and make sure that you are compliant. And that penalty is 27.5. Okay, that is tough. So suppose you have $5 million. I have a client, not a client, but one person was referred. So they sometimes opt to go to OVDI and then they're done because the amounts are substantial, couple of $1 million, etc. Then you cannot go into this 5% penalty program. It's intended for people. They call it streamlined FBAR. It's only for people who are like innocent bystanders and they are really want to comply, but they were not aware of any issue. But amounts should be insignificant to the best of my knowledge.
Yeah. So the last question I think we should
Yeah,
take here is
yeah.
taxable money to purchase property in India, and it was in Indian bank for few days. Does it come under FBAR?
Yes, it does. Even if it is one day. When you exceed $10,000, if it was 15,000 or $11,000 one day, FBAR applies.
Okay. I think that's all. We have the
Yeah,
question.
thank you so much. I really want to thank everyone on the call. I really appreciate it. And Mark, Nancy, nothing makes me happier than giving back to my own community. So I'm from Bangalore originally, and I grew up in Bombay. But I never forget all the great education I got in India and even in the US, and I'm still learning. But I think the book will be out. It'll be very helpful. It's $200, but Lance, Mark, I'll try to get you all a discount as soon as it's published. I get you a discount code that people can use and maybe drive a discount to that. So, okay. So, any further questions, you can email me. A lot of my contact information is here. Let me see if I can find that slide, and then we'll wrap up. And you can So that'll be the website, phone number, office phone number. I'm in the Connecticut office, so happy to do that, and it's been a great pleasure to. Thank you very much.
Thank you, Cecil, and thank you for all the audience and viewers from around the country. People have been dialed in from different parts of the US and maybe Canada.
And
Thank you very much.
Nancy, thank you very much. You're doing a great job. I wanted to mention and thank you very much for everything. You've been doing a phenomenal job. Any way I can help, please let me know.
Yes, and we have this session every month on different topics. And those who are on the audience, right, we are trying to teach how to do an investment, like just from a stock market education. We're going to teach having a mock money, $100,000, how to do trading. Those classes will start from next month. We have the session every fourth Sunday of the month at 8:30 Eastern. Please dial in. You can go log into you can send an email to info@mca-ec.com if you want to be part of the subscription. And thank you again. And we'll see you again next month. And thank you, Cecil. Bye bye.
Thank you. Bye.